Tesla and Apple have long been some of the strongest brands in the world, but today we're going to be going over why I think their future is going to look a lot different than their past, especially when you pay attention to their stock price. So stay tuned as we're going to discuss it all. Apple's share price since the 2000s, really since their inception, has gone pretty much nothing but up. Obviously with dips and things along the way, and today we're going to go over why I think this actually could be changing. An article from Forbes states Apple's stock plunge continues. Here's why it's at a crossroads. As you saw on this chart earlier, if we take a more granular look at the last 5 years or even 2 years, you can see it is off of its all-time highs. Although it might not be that much, we're going to talk about why this actually is significant going forward and what this article was referring to when it says, here's why it's at a crossroads. Apple, as everyone knows, is a giant in the consumer electronics industry. In this article from CNBC, they say nearly all Americans cut back on spending due to inflation, and this actually shows up in their revenue. If we take a look at every year since the early 2000s, you can see this blue line represents their total revenue, which has been overall increasing, and this line which tells you what the percent change was from year on year. You can see, looking specifically at this percent change, it is on a downward trajectory. And in fact, if we look at the past few quarters on a trailing 12-month basis, the last 4 quarters have all been negative growth. It's only the most recent where they were able to even eke out a 0.63 growth year on year, which tells you Apple is no longer the powerhouse that it was, or at least its current trajectory is no longer on pace to keep up with what they had done in the past. You can see it was very common for them to have double-digit growth or very close to it. Even in poor years here in 2006 to 2007, their growth was still between 5 to 8%. That is no longer what we see Apple doing. Apart from this big spike in 2021 when everyone was purchasing consumer electronics at record levels, they have really flatlined. And this could potentially be a story for them going forward. And the reason why this is very important to understand is if you know their current price to earnings, it is priced in my opinion, for further growth. A current price to earnings ratio of almost 30 tells me people think that this company is going to continue to grow. Now, don't misunderstand me. Apple is one of the most amazing companies on the market right now. They have a moat that is crazy wide, and they're going to continue to keep that. But they're no longer going to have the same growth that allowed them to obtain the multiple that they have now. Especially when we look at their price to free cash flow, you can see it's pretty much right on par with their price to earnings. And I don't think a company that's trading at 28 price to free cash flow that has very little growth can remain there. And so is what I see happening with Apple is they are still going to be a fantastic company, but they're going to get re-rated. As people start to see and understand this company doesn't have the same growth that propelled it for years, they're going to say, this is still a fantastic company, but we cannot price in crazy growth. We cannot price in double-digit growth. Heck, even 5% growth is going to look fantastic, especially when you compare it to the last few quarters. And that's where I think Apple could be headed. So I think it might be a really boring next decade or so for Apple unless they're able to find some real drivers of growth, which I don't think are out of the picture. But this is one of the reasons why I personally am not interested in Apple, especially when you consider its price to earnings and price to free cash flow. Even if it's a great company with a huge moat, it has very little room to grow. And especially as competitors ramp up, it's going to get harder and harder for them to get back to any sort of meaningful growth. Now let's look at Tesla. Tesla has been one of those stocks that has driven an absolute mania, which I think is fair to say when you look at their stock chart. If in 2019, sitting at around $15, all the way up to 2021, 2.5-ish years later at $400. That is crazy when you consider this is a company that is in the car industry. And yes, you can see they have absolutely gotten beaten up since their highs here, but we're going to go over why I actually think they have a lot more room on the downside than you might think. This article from Business Insider says Tesla's margin massacre, how price cuts and competition could spell doom for Tesla. And the reason they have to do this in part is due to BYD, who is one of their major competitors in China and is forcing them to change their strategy to really streamline and draw in buyers so that way they can keep their revenues growing. Speaking of their revenues, this is a very similar story to Apple. You can see Tesla has a history of crazy growth in their margins, especially when you consider they are in the car industry. They have growth here in some of these years over 15%, which is crazy. But in the short term, it is in a decline. In the most recent quarter, year over year, they are only up about 1% on a trailing 12-month basis, which tells you they are in a very similar position to Apple, where their growth could be seriously stagnating, especially when you consider they have competition coming in from all angles in some big markets in the US and China. Let's also take a look at their price to earnings. In the past, they have had monster price to earnings. And even recently, you might say it looks good, but they have a price to earnings ratio of 52 and a price to free cash flow that does not look good. And guys, one important thing to keep in mind, earnings can be manipulated just through accounting. Not saying that they're illegal or unlawful, but there are pieces that are non-cash items that are going to be taken into account there that don't necessarily count as cold, hard cash coming to the company. And when you take a look at their price to free cash flow, they're sitting at 181, which in my opinion is very high, especially when you consider a company that is in the car industry. When we take a look at their earnings, one of the biggest arguments that people have of why Tesla is as valuable as it is because they are a tech company. Well, if we look at their actual earnings in 2023, they had $78 million worth of automotive sales. I'm not even going to count these other automotive pieces, but if we just look at that, that's $78 million in sales compared to their total revenue of $96 million tells you about 80% of their revenues comes in just from automotive sales alone. Guys, for right now, this is a car company, and car companies don't typically have a history of monster growth. They have high costs of producing. They're a very capital intensive businesses and don't particularly have the ability to have explosive growth. Now, Tesla itself, I think, has more potential than most, but again, do they have the value to justify a 52 price to earnings or 181 price to free cash flow? In my opinion, I don't think they do. So when you take a look at their chart, even though it has fallen more than 50% from their highs, I think this could have further downside when you take into account where they're currently sitting, competition is coming in, and they're having what Market Insider called a margin massacre. They are just being driven into the ground, and they have to. They cut prices themselves because of competition. So keep this in mind, guys. These are two important companies in the stock market, but you really got to understand what you're buying when you're looking at Tesla and this company in their future. What is their price going to look like? Are you buying them below their intrinsic value? You might know more than I do and have a better understanding. But from my position, I think both of these companies, although they have a great track record, might be at a point where they're going to get re-rated and pushed down to a more normalized level. So take that with what you will, do your own work. This is not advice. This is only my opinion. Great to have you guys here, and we'll see you in the next one.